Say you want to earn 50,000 rupees as a dividend income. Is it possible? The answer is yes, possible. If you want to earn 1 lakh as a dividend income, the answer is yes, possible. If you want to earn even 10 lakh rupees as a dividend income, the answer is yes, possible. So in this video, I'm going to outline some key things about global metrics. What is the dividend income globally? How is it concentrated on few companies? I'll explain you whether the dividend income that you get is a real return or a fake return. And lastly, I will highlight some mathematical calculation for a dividend income of 10,000 or even 50,000. What kind of investment you need to do and what are the consideration points you have to look after before investing in any stock for dividend income. So let's get started with this video. Let us start by taking a look at global dividend statistics and how the companies listed in a developed country contributes to the dividend and how much portion of that dividend generated in the overall economy, overall market of this developed country, these top companies are contributing. So look at this chart over here, which tells that the dividend contribution by the top 20 companies in these developed countries. For Switzerland, almost 90% of the dividend are being given by the top 20 companies in the Switzerland Stock Exchange. Whereas if you see for Germany, almost 85% of the dividend income is generated by these top 20 companies once again. Likewise, if you look after Australia, France and Britain, almost 70% plus of the dividend contribution generated in the list by the listed companies of these markets comes from the top 20 companies. So what does this chart tells us? This tells us that in a developed country, out of all the listed companies, top 20 companies contributes to the maximum portion of dividend given to the investors in those countries. So now you may question that, Ajinkya, why are you comparing this data of a developed country to India? It might be different. You must be knowing this rule that a developing country, India being a developing country, any developing country to that matter follows a developed country culture and the economy. So you must have heard this very frequently that East follows West, which is nothing but the Asia market always follow the Western market, which is Europe and America. These developed markets also have thousands of companies listed in their own stock exchange. But out of all of them, there are few handful of companies which contributes the major portion of the total dividend being generated. This also means that the remaining companies, either they are not giving a dividend at all or the dividend is very minimal by these rest over companies. In order to prove you the fact that the same thing applies to Indian market and the Indian companies as well, let me do a screener search for you for a dividend yield of more than 10%. So if you see this right now, I'm doing a dividend yield of 10% in the screener search. Now, why have I considered 10% over here? I will shortly explain about a difference between a real and a fake return. 10% is a dividend yield minimum, bare minimum that you can expect and you should be expecting when investing in a stock market. So as a result of that, if you see, I'm getting a result of only 10 companies in the Indian market which are having a dividend yield of more than 10%. Out of these 10 companies also, you see all these companies are either old or they are very mature stage companies. Companies such as Hindustan Zinc, Vedanta, SAIL, IOCL. If you look at the market capitalization of these companies, these are in thousands of crores. Now, there has been an old ritual in the Indian market and the Indian companies as well. Early back 2000 period, I would say, the companies used to give very high dividend. Now, these companies has been following the process of giving the dividend from very beginning and they have continued to do so in order to maintain their brand identity as a dividend giver in the market. We have roughly around 2,100 companies listed in the stock exchange. Out of that, barely 10 companies एक genuine dividend देते हैं. That means only 0.05% of the companies are giving a good enough of reasonable dividend in the Indian market. Now, it is very clear that companies are not so interested in terms of giving the dividend. Why is it so? Because now first try to understand the one point that what is dividend. Dividend का एक simple definition होता है कि कंपनी ने कोई भी प्रॉफिट करने के बाद में एक एक्स्ट्रा कैश जो लेफ्ट आउट है वो कंपनी रिटर्न देती है आप इन्वेस्टर्स को इन टर्म्स ऑफ डिविडेंड. सो कंपनी के पास यहाँ पे 2-3 ऑप्शंस होते हैं. अगर आप पर्सनली आपका बिजनेस भी कंसीडर करोगे, आपके पास एक एक्स्ट्रा कैश है, सो यू विल एंड अप विद 2 to 3 ऑप्शंस विद यू. The number one option is what we are talking about right now in this video, that is to give a dividend. The number 2 option would be to reinvest that money into your business because you are seeing a good potential and a growth in your line of business and in your sector in which you are operating. The third option, which is commonly seen these days with these listed companies, are they try to buy back these shares. Now, it is very fairly common for these companies and even rational, I would say, to do that. If I am running a company or say you are running a company and you have got that extra cash, The cash is anyway going to go out from your business accounts to individual investors account. So what would you rather prefer, to give me as an investor in your company as a dividend, or you would rather buy back those shares from me so that you will have a higher shareholding? The prices of the stock will increase because there are less number of shares now floated in the market. So it is very rational for you to think from a purview that I would rather go and buy back these shares from my investors instead of giving them as a dividend. Moreover, India being a developing country, India has a huge, enormous opportunity in every field, in every sector. So these companies are finding many opportunities than the developed countries to invest in India. That's why they prefer, instead of giving as a dividend, utilize and reinvest that funds for their own business growth. Now let us try and understand whether the dividend that you get, is it a real dividend, a real return, or a fake return. Let's try to understand this through this example. In my purview, the dividend that you get is fake, and let me prove you this thing. But before that, let's try to understand some concepts behind dividend. If possible, take a pen and paper, because this learning will be staying with you forever, and try to discuss this with your friends and colleagues as well, because this subject will help you personally grow in your financial literacy. So the point to understand first thing is, what is dividend payout ratio? Now, for any company which gives a dividend, this is a ratio which is seen from a purview of a company. Say you are having a company and you are making a profit of 10 crore. Out of that 10 crore, you today decided to give 5 crore as a return to the investors in terms of a dividend. That means you have decided to return 50% of your profit in return as a dividend. This is the meaning of dividend payout ratio, and that is a terminology used by the companies. This ratio does not resonate much to an individual investors because these are used by the companies. That's what the dividend payout ratio simply means. Second one is dividend yield. Now, say you have purchased a share for 100 rupees. So out of this 5 crore amount, you got a dividend of 20 rupees behind this stock. That means your personal return by investing 100 rupees into that share was 20%. That is your specific dividend yield. Say after a year, the share price is still same, but the company decided to give a dividend of 10 rupees this time. This time it means that your dividend yield at this point in time is 10%. So this also explains one thing, that for every individual investor who is investing in that same company, the dividend yield might differ. So say I have invested into that company for 50 rupees. The dividend that company is now giving is 10 rupees. My dividend yield at that point would be 20%, but whereas for you invested at 100 rupees, it might be 10%. So dividend yield is a metric which changes for every individual. The dividend yield and market yield, these are two different things. Now, what is market yield? So you have understood by now the meaning of dividend yield. What is market yield is, it simply means that, say this same share which was for 100 rupees a year back, now it has gone to 500 rupees and company has given a dividend of 20 rupees. So the 20 rupees return dividend was there in the first year. The same 20 rupees dividend is there in the second year as well. But the share price now is 500 rupees. This simply means that the dividend yield of the market is 4%. So for you, the dividend might be 20%, but for market, the dividend yield is 5%. So I hope it gives a clarity behind these three terminologies. If not, you can just rewind back a little bit and try to understand these three terminologies, because these are very important to know for you as an investor. Now, why do I call this as a fake return and not a real return? The share price of any company does not remain same. So if you have invested 100 rupees back then, but the overall share has declined, the price itself has declined, so the underlying return that you have got in terms of dividend will nullify, and you will not have any real return in terms of your investment. Over and above, this inflation also needs to be factored in. Why? Because a price or a product which was worth 100 rupees a year back, or the year on which you invested, due to inflation, the price of that product might have moved to 105. So you got 110 as a return, but out of that, the value of the product is now 105. Because of that, the net real return which stays in your hand is just 5 rupees, which is equivalent to 5%. So it might look like you are getting a dividend of 10%, but an inflation adjusted return is merely 5%. That's why in the screener search we did a while back, I considered a dividend yield of 10%, and we found only 10 companies listed in the stock market which are giving a very reasonable dividend yield. So here comes the last interesting part. If you ask me whether the dividend of 50,000 is possible or not, the answer is yes, possible. So let's say you want to make a dividend of 50,000 per month, and considering a yearly number, multiplying it by 12, that's almost 6 lakh of dividend is what, that is not even almost, that's exactly 6 lakh of dividend what you want. Now, considering a dividend yield of 10% to be expected from any stock market, and we have seen the list of some stocks which gives you that 10% dividend return, you have to make an investment of 60 lakh. That could be a very high amount in terms of investment and would be a very risky bet if the stock prices further fall down. Thus, if you are investing, do consider all those points that we considered with respect to dividend payout, with respect to dividend yield, market yield, the decline or an increase in the share price, the inflation of the market, and then think and take a very calculative decision whether you should be investing on the basis of dividend or not. That's all about this video for today. Friends, I don't really make videos on news channels or market updates because I feel that these updates and these news channels and this news information, they keep on going. What is going to stay with you is the learning and the coaching that I might be able to provide to you, by way of which you could be a little more wise when it comes to investing. And I want all my viewers to understand the market, to learn from the market, and to learn about investing in their own personal life. So if you are liking my video, please subscribe this button, because the next video that I'm going to talk about is the magic of compounding. Until then, signing off. See you in the next video. This is Ajinkya.